Welcome back to View from the Ranch, February edition. I've got my Chief Investment Officer and partner, Brad Tremitiere, with me. He's obviously showing the love for the month of February. And hello, Brad.
Hello, Greg. Just here to spread some Valentine's Day cheer, and hopefully everybody has special plans for this February 14th. I'm partaking in a little attire here to keep the trend going from December and January. It's worked out so far, so hey, keep the costumes coming.
Yeah. Do you have any big plans yet, though?
No, my wife's going to be out of town, so I guess I'll be eating alone with my dogs.
Well, I'm sure they will appreciate your attire.
Yes,
and,
yes, very much.
Where did you get all this stuff?
I don't give away my sources.
Oh, okay.
Yeah.
Custom made.
I've got special places here in Sarasota that
Got
I
it.
pick up these wonderful outfits from a Walmart. Very nice place.
Nice.
Yes.
Good to hear. Supporting local. All right. So as always, we're going to be stepping back from the headlines and really drilling down to what's actually going on with the markets, what's going on with the economy, and what's actually driving the markets and what matters to long-term investors. I'd say that's how we categorize ourselves versus the short-term trading societies that are out there. So we're going to walk through what's going on year to date, where we stand, what we're thinking about, what's been happening. So kind of a different start this year, right? I mean, as far as the leaders, there's a clear difference of the technology companies taking a back seat for the first time, I think, in quite a while. So you're starting to see other areas, which we've been discussing, other sectors, more value-based, more dividend-focused, that are starting off the year pretty strong. So how do we end up in January?
Well, January for the most part was pretty strong across the board. I mean, especially in small and mid caps, as well as, the New York Stock Exchange. S&P was okay. NASDAQ was obviously a little choppy, but it's good to see this type of rotation. And it's kind of been in the works now for a few months, as the heavy lifting of all the big name tech stocks for the most part has stumbled a bit since last quarter's earnings. But it really became much more of a driver, since the calendar rolled over. So it's good to see materials and staples and, communication, utilities start to lead again. Utilities have been a leader for a couple of years now, but it's good to see some of this rotation take place. My question always is the rotation going to stay? I doubt it does, because it never has, for I don't know how many years now, but maybe this time it's going to be different. Maybe this time we'll see continued outperformance from, names that haven't done any heavy lifting in quite a while.
Yeah. Which is healthy, right? You always talk about market breadth, and you want to see that start to expand other than just the top 7 technology companies out there. And
well, interesting enough, as of Friday, which was February 6th, we made a new all-time high again in NYSE breadth. And I went back and looked at, trying to, put some, you put some parameters around this year because it's midterm year. So I looked at the performance, of New York Stock Exchange breadth, back to 1962 during midterm years. I don't know how many there are, 20 or so. And it's really interesting because on average, the breadth for the market is through February 6th is down. As of Friday, where breadth is up over 5,700 issues. It's extremely strong right now. And that basically tells us, well, there could be a pullback in the market. There could be some weakness that we run into because of the strength that we're seeing. Any weakness should be, limited, and we should be able to rehabilitate the market. So we're getting a lot of strong lifting from different areas, and it's helping the overall, it's helping to strengthen and improve the overall health of the market.
because as of right now, as we're recording, technology sector is slightly down for the year. Consumer staples is really one of the top, which they were, I think, last year one of the worst performing sectors, and industrials and energy. So what's like energy is up 17% as we.
Well, we've seen a lot of these names. I mean, of course, there's names like Exxon that have finally broken out, and some of the refiners like Valero that have done well. But in the cases of energy, in the cases of consumer staples, there are a lot of stocks that are just reversing their downtrends. Doesn't mean that it's a new trend up for them, but some of them have been beaten up for so long. they're finally catching some action.
Can't go down forever.
Correct. Right? Hopefully that these moves turn into something more than just, an intermediate term rebound. It's also a factor of what's going on in technology too. There's nothing wrong with what's going on in technology. The earnings and numbers are, off the charts. The main issue is that these companies continue to spend like there's no tomorrow. I mean, the amount of money that Google and Amazon last week increased under 2000 capital expenditure estimates was astronomical. I mean, it 3-4 years ago was more than they would spend in a year. Now they're saying that's going to be their increase over the massive amount that they already have had. So there's been a growing skepticism that this heavy spend to build out AI and data centers and everything that has to do with the future of artificial intelligence will not, manifest itself into as much of a profit as expected. So money has been rotating out and it's been finding some other areas to go into. It's just going to be interesting to see if these areas last longer term, or again, if it's just a rebound from extended period down.
Yeah, it just seems like everybody, once the crowd decides that they're spending too much, and then it just seems like it runs with it, and whether they're right or not.
Yeah,
who knows?
And you look at energy. I mean, energy stocks have outpaced the price of oil, whereas oil's up. I don't think there's a long-term trend there for oil to keep going higher. So I'm not sure the energy sector will be a leader at the end of the year. But it's good to see some other areas lift the market.
And corporate earnings have been pretty good, and so that's been a driver of some of the stocks that have been beaten up. Some of their valuations have gotten cheap enough, and companies are making money. It seems like a lot of companies are a lot leaner these days, and certainly it gets reflected in what they're if they're hiring or not, or if they're letting people go. It seems like a lot of companies are doing like a hiring freeze. There hasn't been huge layoffs, although you're starting to hear some. Mm-hmm. But it seems like probably with the use of technology that companies can just operate leaner, and that their profit margins have stayed high. Quite higher than they normally have historically. I think that companies are just able to do things leaner and faster and make moves a little bit quicker. There you go.
There we go. Now we're dressed up.
Look at that. This
well,
is a stud.
If there's been anything wrong with earnings, it's that they haven't been good enough. You've seen, especially on some of these tech stocks where they've both posted great earnings, but there might be one or two things that are off that causes the street to take these stocks out to the trash bin. But overall, earnings have been very, very strong. And, it's kind of supportive of what we've seen in the GDP numbers too over the last couple of quarters and the strength we've seen there. And one of the most interesting things so far, I mean, we're probably more than halfway through earnings season, and we're past the big point of earnings season. Unlike last year at this time, I'm not sure the issue of tariffs were ever spoken in conference calls that I listened to. Last year is all about tariffs. This year we've kind of moved past it. We kind of understand, what the implications are and how bad they're not going to be. So year-over-year basis, it's kind of interesting to see the change in verbiage from what these companies have been talking about, and that fear of tariffs or increasing tariffs isn't there anymore.
It's so interesting how someone makes a comment that tariffs are going to be bad, that everybody follows suit, everybody's a tariff expert now, and it doesn't come in to mean anything actually so far.
It hasn't been passed through. Maybe it does at some point. I just don't, at this point in time, I just don't see it, because I don't think tariffs are going to get worse from here.
And even the Fed was talking about it, but now, and the Fed was concerned that, maybe they won't be able to cut as much. What's the Fed up to these days? Are they still expecting to cut twice, or are they just on hold mode at this point?
Well, we had a meeting a couple weeks ago. There was no change. They didn't cut, but
you think they need to? Because it seems like they're probably at fair value,
they're
neutral.
I still base it off the 2 year. If it's based off the 2 year, they're still too tight. Okay. They will cut this year, just a matter of how much, whether it's 2 or 3 cuts. The verbiage had changed a little bit about inflation. It's not so much that they're concerned about inflation, And they may have moved even a little bit more neutral on unemployment. But, for the most part, what they spoke about was what was expected and really no change to their outlook. Wait and see what happens. And I think at this point in time, they're moving more to being concerned about unemployment data than they were about inflation data.
Okay. Because the job numbers have been, they seem to not move the needle a whole lot. It hasn't been too hot, too cold. Again, there hasn't been a huge increase in layoffs. It's just, if you have a job now, people are not jumping around from job to job like they used to. And those who do not have a job right now are finding it difficult to acquire a new job. And it seems like that doesn't seem to hasn't been changing the last few months. And so if you think the unemployment numbers will start going up, maybe the Fed will get more aggressive.
It has to be shown to us first. We get numbers this week for January, and we're not expecting much, but we're not losing jobs. To me, the jobs that they've gotten rid of so far have been jobs that weren't necessary over the past couple of years. Just wasteful spending. And I think there's still more of that to go. But on the other side,
government sector?
Yeah. But as you said, on the other side, there's not a whole ton of hiring either. So, unemployment remains under control. It's no major disruption. We look at weekly jobless claims. They're pretty much in line. There's no major outliers. We're not seeing 300,000, 400,000 per week in weekly jobless claims. So until we get consistently above 300,000 a week in jobless claims, I'm not sure there's any real major issues going on out there.
Which means people can still spend. If they have a job, they can still spend, although spending has outpaced the rate of wage increases. I think we read that for the consumption has outpaced disposable income for 7 straight months, which could mean that people who, we talked about this K-shaped economy, the haves and have-nots, that those that have portfolios, that have assets, they're starting to draw from those assets rather than just on all income, and they're not taking on like a bunch of debt, which is nice, but they have assets. The market's been great for how many years. And so those who were able to invest have some additional capital to spend. I think we see that too. I think we see that in our own practice where a little bit more distributions are coming out, some one-offs coming out if they need to pay something down. There's because the market's been good, that's been a driver. So the concern would be if something flips where the market starts to sell off and people don't feel that wealth effect anymore, how's that going to affect the stock market, the economy? Because if they can't access it as much, that would be something I think that we would keep an eye on. But it's hard to, I think, have a recession if everybody's fully employed.
And the simple fact that we're going to get a massive stimulus here for the next couple months of tax refunds.
About that. Yeah, nobody's talking.
And we've mentioned it before,
We
but
have.
there's going to be a massive amount of money, maybe 50% more of the 2025 refund amount that's going to be coming back to U.S. taxpayers. If you had a $800 tax refund last year, you probably get somewhere between $1,200, $1,300 this year. It's going to be a big benefit for the middle and lower classes. Probably their biggest benefit since COVID checks, and it will help lay out more of a runway for spending that should hopefully get us through, most of this midterm year. And that's, always the issue is that strange things happen in midterm year. So maybe this will help lessen any disruption of consumer economic data moving forward.
Having a pretty decent January, that usually sets the tone for the rest of the year.
You can say that. I think some of these old Wall Street, we call them adages.
Maxims?
I'm not sure. Slogans, myths, whatever. I don't think they hold as true as much because of, the way trading is done now. But if you can put a couple of them together, I think it gives you better opportunity. So we haven't spoken about it in a couple of years, but we have something called the January trifecta, where you take in the Santa Claus rally, which is the performance of the market, the S&P over the last 5 days of December and the first 2 days of January. The first 5 days of January, which is trading over the, from January 1st to January 5th. What's the return of the S&P? Is it positive or negative? And then just the January effect, which is, the total return for the month of January.
So goes January, so goes the rest of the year.
Yeah.
How did all three of those?
Well, the Santa Claus rally this year was down like 0.1%. But it's been down. It was down last year, it's down the year before. So it's not like that number automatically means it's negative. We're going to have a negative year in 2026. Mm-hmm. On the other hand, both the first 5 days of January as well as the entire month of January on the positive side. So going back and looking at all that data over 76 years, what is really interesting is that when we get a period where both the first 5 days and the month of January are positive, like we had this year, the expected return of the market is pretty solid. You can't say it's going to happen, but over that, there's been 36 times that's occurred, and the average S&P return that year is about 17.5, which we'll take. We'll take 17.5, especially in a midterm year. And if you go back and look at even more of the data, there are 4 years that we had that occurrence that were negative. Only 4 out of 36. So again, a little bit more than 10% of the time it doesn't work out. Mm-hmm. But for the most part, those years where, 1994, we lost 1.5%. 2011, we were just down less than 0.1%. 2018, we were down 6 and change, but that all happened, October, November, and December. So 1966 was down 13%, but that's, you're going back to a different time at this point. So because, the first 5 days were positive and the month of January are positive, it's just another indicator that tells us that we should expect the year to be positive. Doesn't mean it's going to be positive, but
better odds.
If we can stack, say, this reading together with what we're seeing in New York Stock Exchange breath, the move ahead should be pretty good until something happens. Mm-hmm. I don't know what that, maybe it's tech stocks pulling the market down because they're spending too much money. But for now, things look pretty healthy.
Okay. And then we're also getting a boost from overseas spending, right? I mean, the international markets actually, a lot of them outperformed our markets last year. And then with the U.S. stock market being comprised of a lot of global companies, we're getting a little kicker there as well. That's helping.
International was great last year, and it started off the year for the most part pretty well. It remains to be seen if that lasts, just like the rotation we're seeing in the areas like consumer staples and materials. Is that a trade that's going to last? Again, I doubt it. I mean, the last time we saw extended outperformance in international markets was back at the end of the tech bubble blowing up and after September 11th. But there's always a chance. What I find interesting, and maybe this is just conspiracy theory on my parts, but when I go through the different programs we have to look at the stocks that we own in our models every day, I go through these programs to see what different, brokerage firms, banks, research companies are saying about these stocks that we own, and where they rank them, what they think the stocks are going to go to, and it's really interesting because I'd probably say 75% of the stocks in our models that I look at the data every day. Most of the European brokers and bigger banks have everything American basically rated neutral right now. They all seem to think that our market's expensive and their market's cheap. So that may be the point in certain areas, but
it's always been like that.
Yeah, I just find it interesting that even on some of the bigger and stronger names that they're considering them neutral at this point in time. It's just strange. I got to believe it's strictly valuation, but they can. You've seen some of these investor, wave the flag this past few weeks about how great international's done versus how good the S&P's done. Sure, that's the case, but draw that chart out over 20 years and it's a completely different story.
Right.
So we take the trade for as long as it goes, but it's going to take a lot more work. And international is most, especially emerging markets, but a lot of the international returns are based off commodities because the countries are such commodity dependent. So, they tend to do well when oil does well, and they do extremely well, as we've seen with gold and silver going nuts. So the commodity side has helped lift the international market as well. Does it keep going? I don't know.
Now we saw a big change with the gold and silver recently, or is it a big sell-off? What do you think going forward? I think probably a lot of people would want to know, like, what's your thoughts on?
I think they were too high, a couple months ago. Gold has some value from a quote unquote monetary standpoint, which, both of them going up, you got to scratch your head a little bit. Is it a knock upon the US dollar? And that's why you really don't need these things to keep rising like they have. But in this environment where everybody runs to one trade or another, I believe you had everybody running to both of these. And, the ultimate killer is when the exchanges come in and start lowering margin, start raising margin requirements, like we've seen with the CME now a couple of times. And that's really what caused the first drop, a week or so ago. So I think I would have to say the tops are in. I think both of them end the year lower from here. Any rebound that gets up close to where gold and silver were previously should be shorted.
And taking profits. Like,
yeah,
just
taking profits.
We're always fans of trimming positions, adding to positions. You could sell completely out, of course, but I always just think at least sell a third or something.
It
went straight up.
Yeah, these are historic moves. Yeah. And
how many deviations? Standard deviations?
Oh, it's too many to count. But stocks usually round when they make a top. It's a process. But as we've seen in commodities, it's always a blow off. And what we saw in both gold and silver has been the ultimate blow off. Mm-hmm. You draw back to 2011, the last time this happened. It wasn't on as big of a scale, but on a percentage basis, it's somewhat similar. And in April 2011, they came in and tightened down the margin requirements on both of them, on both gold and silver, and they both, drop significantly for the next couple of years. I don't think they drop for the next couple of years, but the excessive fluff that was in them is going to come out, and it's come out quickly, and I expect it to continue to come out. Silver is more of an industrial metal, so from a inflation standpoint, we really don't want that, silver to be $80 an ounce, $90 an ounce, or whatever it got up to $100 an ounce. That's just a larger expense that flows back to the consumer, which we don't need at this time.
Now, there's also a change this year that small caps and mid caps are outperforming large caps, which I don't think has happened in quite a while. Do you think that trend continues, or what do you think is behind that? Just interest rates?
Well, it should continue from a better interest rate environment and a better tax environment. That should be the number one, they should be the number two reasons why those two market caps would go higher. That was somewhat the same way last year, and they didn't. So, again, it's really show me. It's really show me with both of them because they have not been as strong versus the larger caps for an extended period of time. Sure, we'd love to see them outperform, but the problem that we get is when we have a month of January where the small caps are up like 8%, 3 or 4 months from now, we're going to have a month where small caps are down 8%. Yeah. It's always give and take. It's hard to, it's one step forward, one step back. Again, it needs to show us. And, some of the smaller caps that we own have gone crazy and have started to come back to earth. Again, I would put big moves in small mid caps along the lines of big moves in gold and silver. You take advantage of spikes in pricing and take your profits when you can and look to reallocate back in. They just can't run to the moon like some of them have.
Now, you recommended some changes in some of our model portfolios of certain sectors. What were some of the moves that you made that earlier on in the year that might want to share?
Well, we've added some healthcare. Healthcare looks to be really supportive here. And a lot of healthcare has not done well the last few years. So we've increased our exposure to some healthcare. But we've started to also, I would say, bottom fish almost on some of the, bigger blue chip style names that have cheap earnings and pay high dividends. And those dividends are well covered. So it's going into some areas that, we may have not been invested in the last 3 or 4 years, just from a fundamental standpoint. And we've shaven a little bit here and there in some tech and a little bit in financials. But again, over the years, anytime we sell in those areas, it always seems to come back and get us.
Well, you just have so much capital to work with.
Yeah.
So if you want to bump up healthcare, bump up consumer staples, we did that at the expense of a little bit of financials, I think consumer discretionary as well, right?
Yeah. But, the sector rotations happen, but at the end of the day, most of the sector allocations usually stay the same. So we've done some moving back and forth, so it'll be interesting to see where we end up the year. We've added a little bit more international exposure, but again, some of those markets that we're in have gone nuts, and it's not really something that we want to turn around and chase at this standpoint. So, I'm not going to get into specifics, but they've been good trades so far that we've made. But there's always that, person, little person in the back of my head saying, okay, how long can this go on for?
Okay.
Because we're talking about companies, good solid companies that have, might be up 10 or 15% since when we bought them, but we bought them after they were down 65%, 70%. Things just don't change that quickly. Just because we're in a new year and there's some rotation doesn't mean a company's good. So we've seen improvement in some of these fundamentals. That's why we took some chances, but we need to see that fundamental improvement continue on.
So you're pretty much, sounds like, staying business as usual this first quarter. A lot of positive check marks for you, I guess.
Yeah, it's still midterm year though. So it's still a midterm year. We have to.
That worries you?
Yeah, because we have to expect some disruptions along the way between now and October. But, you go back to 2022, the market's in a much different place. You go back to 2018, the market's in a much different place. And again, the Fed should be a tailwind. It should be even more of a tailwind with the new Fed chairman coming in this year. We understand that bond yields are going to remain sticky. So that's always going to cause some discomfort. But that stickiness this year is solely based on the amount of debt we have to refinance. So eventually, at some point this year, that's going to become a tailwind too. So there are a lot more positives that are out there that should keep the market going in the right direction, considering it's a midterm year. But I don't put past, elevated volatility over the next couple of months just because it's the midterm year.
I think a lot of what we're recommending and the way we've been managing our own money is maybe trimming a little bit on the tech side. You don't want to get rid of technology. All the growth's going to be there, and it's always going to get ahead of itself and moves where it's up 100%, and then it's going to consolidate for a while. But adding, if you don't already have more value, dividends, a little international, some consumer staples, like things that have been underperforming, we think makes a lot of sense right here.
Yeah.
And it started off already on that trend, and we'll see if that trend continues. And the markets are really, it seems like a little different scenario where the markets are, because they're up, that's helping people spend more money. And rather than like that, the economy is doing so well, everybody's getting pay raises and salary increases. And so that would be worrisome if the market did shift. How would that domino effect affect spending, which is, of course, the primary driver of our economy and GDP. But so far, it just seems that we continue, the rebalancing. If you were a 60-40, probably stay 60-40, right? 60, bonds and stocks. Like, we're not saying go aggressive, go 70-30.
Yeah, there's no reason
in the asset allocation, and I think that's the stance that we're gonna stick with here for a while.
And as we get closer to the end of this year, that's when we can start pressing the gas a little bit too, because this midterm year always leads into the presidential pre-election year, which is always the best of the bunch. And I don't know why it works out that way all the time, but it does. And it hasn't been a negative year for almost 100 years now. So
if we do get a pullback, maybe that would be the time to maybe change your asset allocation.
Perhaps.
Get a little bit more stock oriented.
I can tell you the one thing that would send the market to the moon is for the mega cap tech companies that come out and say, we're spending $200 billion this year on capital expenditures, and then next quarter come out and say, we're still planning on spending $200 billion this year on capital expenditures. Once that spending stops going up, you'll see the tech space really catch a wave. Okay. Because there are some companies that are benefiting from this. There should be a lot of companies benefit from this spending, but the problem is the larger companies are kind of masking any strength that's below there because of the way the market's reacted to their increases in capital expenditure over the last, we go back probably 12 quarters now. So
it's a surprise of how much more they're spending.
It's just never ending. Yeah, it just keeps going. So we're thankful because that's probably kept the economy out of recession in 23 and part of 24 that everybody was calling for. And it's good to see other areas of the economy now doing the heavy lifting. But it's important that all that money that's getting spent, materializes into profits at some point in the future, which they should. But we've never seen spending at these levels. I mean, these companies are spending more than the GDP of half the world probably right now. But it's a race to get there, that's for sure. Yeah. So, but other than that, I mean, it's surprisingly for how good the last 3 years were, and this being a midterm year, it started off pretty well.
All right. So people can go take their dates to the steak dinner still.
Sure. Why not? And I mean, here in Sarasota, it's spending every day. Yeah. You better have your reservation, for dinner, no matter what night it is. And you still got to fight to find a parking lot because it doesn't look like there's any economic problems in this town.
Yeah. Well, that's true. That's what we're the bubble that we live in.
Yes.
And we're blessed and grateful. All right. Well, that wraps it up for the February edition of View from the Ranch. Stay tuned for March edition and maybe St. Patty's Day for you. Is that?
Yeah, we'll see. I don't know. I don't know when Easter is. If Easter's in, maybe we'll do St. Patrick's Day, and I'll just drink a lot before I come on.
It'd be quite interesting. So.
Sorry, Mom.
All right. Well, you guys take care. God bless.